So I recently had somebody ask me, what does it mean when you say the average price of a share or the average cost of a share, or what does it mean to average down? And so I wanted to do a little video on answering that question, a quick video to let you know what does it mean to find the average price of the shares that you own and why that's important, and also helping you understand the importance of averaging down when you can and why you need to average down as often as you can and how that can be a powerful strategy in your investment portfolio. So without further ado, let's jump in. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. And in this video, we're going to talk about a strategy that you can use to grow your money more efficiently and effectively in the stock market. And one of the strategies that's important in the stock market is to learn how to average down, or what's called dollar cost averaging, and where you average down the price of the share that you have. We're going to share with you an example. I'm going to show you my personal portfolio on one of the shares that I have that I've been averaging down over the last several months. In this video, I'm going to share with you a spreadsheet. I'm going to show you a couple of things about how to calculate the average price of your share. Now, most brokerages, like if you have, like for example, I have Webull, which by the way, while we're here and talking about it, click the link in the description below right now, because if you do and you join Webull and you deposit $100 or any kind of money in there, you'll get a bunch of free shares of stock. What better way to start your investment portfolio and your investment journey than with free shares of stocks? Some of these shares could be worth up to $3,000. So definitely click the link in the description below, get your free shares of stock, open your Webull account, and then come back to my channel. Continue to watch my Webull journey videos so that I share with you how to be an investor with the Webull platform and Webull portfolio. But whether you use Fidelity or Charles Schwab or Robinhood or any of these, most often they're going to calculate the average share price for you automatically, but it's still a good idea for you to keep track and to know how it's calculated so that when it comes time to sell, you know if you're selling for a profit or a loss. So let's jump into the spreadsheet that I've just created, and then I'll show you my actual account on Webull so that you can see how it works and how the difference is, and we'll share with you some of the things there. So first thing I want to show you is this sheet here. So let's say you have a particular stock that you want to buy and it's a certain price. So let's say you have 10 shares that you want to buy, and let's say they're $10 a share right now. So that's a total price that you're paying of $100 to have those 10 shares. So the first time you buy that position, or the first time you buy that stock, however many shares times however much money you're making, that's your average price. Now the next time you buy that stock, it's going to have a different price. So let's say you buy another 10 shares, but the price has gone up to $11 now. So your total here is $110 that you've spent. So total cost of the 20 shares, you've spent $210, but the average price per share is $10.50. So basically what happened now is that if the price of that stock continues to rise, you're going to be in a profitable situation. But what if the stock goes down? Let's say you buy another 10 shares and it's down to $9 a share. So that's $90 total dollars for that particular transaction. Now you have a total of $300 right here. You have a total of $300 that you've invested into the account, 30 shares you've bought at 3 different prices. So your average price is back to $10 because you had the first time you bought was at $10, the second time was at $11, and the third time was at $9. So you can see the average is $10. So if that stock price at any point is over $10, you know you're in the green. Any point it's under $10, you know you're in the red. So being in the green is where you want to be. Being in the green is having the ability to sell everything and have a profit left over, or have money left over, or basically get a rate of return. If you put in $300 and you sell it for $300, you broke even. But if you put in $300 and you sell for $400, now you made $100 on that. Does that make sense? So the idea here is to get your average price of a share as low as possible. So let's say that right now what's happening in the marketplace, especially in, so this is fourth quarter, of 2022. Right now we're seeing a really bad stock market, ups and downs and swings and all over the place. So when you see a stock, let's say for example, go from $10 a share down to $5 a share, which is what we've seen in a couple instances, what you'll see is that average price goes down to $8.75. So unfortunately, you're looking at your account and you're frustrated because you have 40 shares now that you've bought at now you have 10 you just bought at $5 a share, but you have 40 shares that are worth $5 a share. So you've put in a total of $350 and the average price is $8.75. So if right now in the market you just bought 10 more shares of that position and you bought them for $5, that means that stock is only worth $5 right now. That means you're literally in the red because the average price of your shares is $8.75, or $3.75 more than the current price for those shares. So now you know you're in the red. You know that if you were to sell out of that position, you would lose money. So the idea here is to at least wait to sell your shares, wait to sell your positions until you have an average price, or the price of the stock is back over $8.75. So let's say you have another moment of just the absolute tank in the market and you're down to $3 a share. Now your total portfolio, all these shares that you bought, they're only worth $3 each. You've spent a total of $380 to get into it, but it's only, your average share price is $7.60. The current share price though, because you just bought some, remember, the current share price is $3 a share. So you're now less than half. You're really in the red right now. So here's the thing though, is that you know that if the stock price was at one point $10 or $11, you have a pretty good chance, as long as it's a good, solid, strong company, which I highly recommend. You're only buying good, solid, strong companies that you do good research into. Don't just go buy a share just because it's cheap. Buy good, strong companies that you know are going to be around for the long term, because after this market fluctuation that we're in happens, after the lows and the highs and all the ups and downs we're doing, you want to be able to have shares in a company that's going to be there. It's going to still be around. And perhaps some of the stocks was overvalued when you first bought them, but the idea is that as those, maybe we're having a correction right now to kind of clear out some of the stuff that we don't need. Well, eventually that stock should come back to where it was, or at least clear this average price. So if you bought it at $10 or $11 or $9, you can be pretty confident that it might go back there, especially if it was a good, strong company. So hold on to it. Don't sell at $3. Now your average price is $7. You're literally going to lose money. You're going to lose about $4.60 a share on average. Now, let's say that thing goes back up though. Now you buy another 10 shares and it goes back up to what it was originally, which is that $10 amount. The good news is that you have $480 in there. Your average share price is $8. You literally sell all of your shares now. You have 60 total shares. If you sold all of your 60 shares for $10 each, you would literally make $2 each, or $120, because 60 times $2 is 120. You'd make money. So even though this is what dollar cost averaging will do, and this is how you find the average price, and this is why dollar cost averaging is important, because as the stock prices come down, you want to buy more and more shares to bring your average price down, because the hope is that as that price goes back up, you're going to be able to take advantage of that and sell when it comes back up, even if it comes back to even if it comes back to the same amount that you first started with, which is $10. You can see that your average price now is $8 because you bought so many shares when it was 3 and 5 and 9. Does that make sense? So let me share with you my particular portfolio, my SoFi history of my SoFi purchases, so that you can see exactly how it works and why it works that way. So let me show you. Okay, so this is inside my Webull portfolio. This is my SoFi position. As you can see, I first bought my first SoFi position back in November 29th of 2021. So almost a year ago today, or a year ago at the end of this month. And so I bought 100 shares, and it says assign there because I bought it through options trading. I did a cash secured put. I got assigned the 100 shares at $18.50. Well, unfortunately, right now, SoFi is trading. If you look up here, SoFi is trading at $5. It's right here, $5.33. I've lost, actually. So I'm in the red on SoFi, but I'm using this to show you and illustrate to you why it's important to keep your average cost and know your average prices. So as you can see, I bought another 100. I bought over time, every couple months or every month or so, I bought a couple hundred. And as you can see, $14.50, $14, $13.95, $11.90, $11. So I kept buying as it went down, and then I stopped at $9.50 and I waited because I didn't know where it was going to go. And so I ended up buying another 300 shares in the $5 and $4 range here. So my current average price on the SoFi stock is $10. You can see it up here in the corner here. I don't know if I can't zoom in, unfortunately. But you can see my average price up here is $10.81. The last price for the stock, or what it's trading at today, is $5.33. So when I first had this stock, I paid $18.50 for it. My hope is that it will go back to that. My hope is that it will come back to at least over $10 share price. And they're saying this, the analysts are saying that right now it should be around $8 to $10 in the next year or so. I'm hoping that's the case. I'm hoping it's better than that, because what I've done over the last several months is as I've continued to buy, I've bought it and I've averaged down. That's what dollar cost averaging down means, is by buying more shares at lower prices, it brings that average price down. So it started at $18.50, $14.50, and now you can see it's $10.81 because I bought at lower prices than the $10, it kept bringing that down. And I would like to get it down lower, but I'm just a little nervous to keep buying SoFi right now until I see some movement in the right direction. So I hope this helps you understand the importance of understanding why you want to keep track of your average price, why you want to know what it is, because if you're selling below that, if right now the stock share is below that, you're in the red probably. If it's selling above that, you know you're in the green. And it gives you some hope as well to realize that the stock doesn't have to climb all the way back to that original price that you got in order for you to break even. All it has to do is get over that average price. Once it's hit the average price and over, you're in the green and you're ready to sell if you want to. Now, one of the reasons why I love dollar cost averaging is because in my dividend portfolio, I average down my price per share, but that continues to increase my dividend income. My passive dividend income increases as my price per share decreases. That's the perfect game right there. Decrease your average share price by increasing your income. I hope you got a lot out of this video. If you missed the last video I produced, you can find it here. Go ahead and subscribe to the channel up here and check out this video that YouTube thinks you might like. Until the next video, have a fantastic day.